Welcome to Talk Tickers. Today we're diving into the first quarter 2025 earnings call for DLO. They're a big player in emerging markets payments.
Yeah, and it was quite the call. They reported record highs on, well, quite a few key metrics. A really strong start to their year.
Absolutely. Let's get right to those numbers then. Total payment volume, or TPV, hit $8.1 billion. That's up 53% year over year.
And what's really striking there is this constant currency growth, 72%. That tells you a lot about the underlying business strength, taking out the FX noise.
Good point. And even quarter over quarter, it was up 5%. But, the number that really jumped out at me was the TPV net retention rate, 144%.
Oh, definitely. A rate like that is exceptional. It means their existing customers aren't just sticking around, they're processing significantly more volume through DLO.
So real stickiness and expansion within the customer base.
Exactly. It shows the platform's value and how embedded it's becoming in their clients' operations.
And that flows through to the top line, right? Record revenue, too, $217 million. Up 18% year over year.
Or, again, looking at constant currency, a much healthier 36% growth.
Right. And gross profit also hit a record $85 million. That's a 35% jump year over year.
Nearly 60% in constant currency there. So strong performance across the board, really.
They even managed to improve efficiency slightly. The adjusted EBITDA to gross profit ratio ticked up to 68%.
And solid cash generation, too. Free cash flow conversion was 85% of net income. Pretty healthy.
Yeah, these are strong operational figures, but they also announced something pretty significant on the capital return front.
Yes, the dividend news. They're starting a regular dividend policy.
Yeah, that's right. 30% of free cash flow annually, though that kicks in starting 2026.
But they didn't make shareholders wait entirely. There's that special one-time dividend.
A big one. About 7.52 cents per share, roughly $150 million total. Payable pretty soon, actually, Juneteenth.
It signals, I think, a certain confidence in their ongoing profitability and cash flow. And maybe, given what they said about stock liquidity, it's a practical way to return cash right now.
And makes sense. Okay, so let's dig into what's actually fueling that huge TPV growth.
Well, a big piece seems to be cross-border payments. They specifically called out strength in places like Chile, Pakistan, Nigeria, Turkey, and Brazil.
And it's not concentrated in one sector either, is it? They mentioned growth across remittances, e-commerce, financial services, even streaming.
Right. It's quite broad-based. It really highlights the versatility of their platform, meeting needs across different types of transactions in different geographies.
That geographic diversification seems to be a key strength. Other LATAM markets apparently contributed well, but Brazil was a bit of a mixed bag.
Yeah, it's an interesting one. Volumes were actually up year over year in Brazil, but revenue went down.
How does that happen?
Two main reasons they cited. One was a strategic shift towards a payment orchestration model for a large merchant, which tends to have lower take rates per transaction.
Okay, so lower fees on those specific flows.
Exactly. And second, just a change in the mix of payment types from that same merchant. Plus, they had a $2.5 million one-off hit from some extra processing costs there in Q1.
So some headwinds in a key market, but they expect that to ease.
They do. They mentioned they'll start lapping some prior year repricing in Q2, so some of that pressure should lessen. It might be a short-term pain for long-term gain kind of move with that orchestration model.
Okay. Then moving over to Mexico.
A bit softer there, particularly in commerce volumes. They pointed to seasonality and losing a bit of share of wallet with one large merchant.
But still growing sequentially?
Yes, sequential growth was still positive, which is, encouraging.
And Argentina sounded quite strong, especially these advance in volume products.
Right. These products apparently carry higher take rates. It ties into installment payments and factoring receivables, which is a big deal in markets like Argentina.
So essentially, they're facilitating installment purchases and getting paid a bit more for it?
That seems to be the gist. And they feel it's sustainable given the structure of consumer buying there.
Okay. Now, what about the higher costs mentioned in Africa and Asia, specifically South Africa and Nigeria?
Yeah, they acknowledge processing costs went up there. It sounds like a deliberate choice, though. They prioritized routing for performance and reliability over pure cost optimization in those instances.
So ensuring the payments go through smoothly, even if it costs a bit more short term.
Precisely. Which you could argue is critical for building trust and maintaining service levels in those high-growth developing markets. The challenge now is to optimize that cost structure without compromising the performance they prioritized.
Makes sense. And commercially, they seem busy strengthening ties. Partnerships with two ZEPs WPPY mentioned across multiple regions.
Plus expanding further into Africa to support their merchants' growth. These kinds of partnerships are often crucial for scaling quickly in emerging markets, leveraging local expertise and networks.
Definitely. Let's talk tech. Big focus on automation and AI, it seems.
Very much so. They highlighted improvements driven by AI in customer experience and compliance monitoring.
And automation helping with things like chargebacks and refunds.
Right, and faster setup times for new integrations because they redesigned that system. Also, improvements to their settlement system. It sounds like a concerted push for efficiency.
And they expect this to translate into slower hiring growth down the line and better operational leverage.
That's the goal. Investing now in tech to handle scale more efficiently later. They also mentioned ongoing work like smart request strategies using machine learning for conversion rates and smart 3DS for security.
Plus expanding their licenses. 3 new registrations in Argentina and Chile. So shoring up the foundations.
Exactly. Building operational muscle and regulatory footprint.
Okay, looking ahead then, despite, all the global macro uncertainty, they reaffirmed their full-year guidance.
Yeah, they seem confident. They're really leaning into the long-term story, the secular growth trends in emerging markets.
Demographics, tech adoption, that whole narrative.
Right? Young, tech-native populations driving digital payments. They even see potential upside from shifting global trade patterns, with more developed economies needing to engage with emerging markets.
Interesting angle. They do acknowledge competition is heating up, though.
They do. Their stated plan is to differentiate through reliability and cost effectiveness. And they'll keep investing in tech, but still aiming for modest margin expansion this year.
So confidence, but realistic about the challenges.
Seems that way. The reaffirmed guidance suggests things started the year broadly on track, despite the noise.
Now, back to capital allocation for a second. The dividend policy clearly signals returning value, but they stressed keeping flexibility too.
Right, flexibility for strategic goals, potential M&A, maybe more CapEx if needed, business development deals.
And they specifically chose dividends over buybacks right now because of the stock's limited liquidity.
That was their explanation. Makes it a more direct way to get cash to shareholders currently. Doesn't mean buybacks are off the table forever. They've done it before.
And they still have plenty of cash and short-term investments on hand.
It's a significant amount, yes. Gives them options.
And speaking of options, M&A is clearly one they're considering.
Actively looking, they said, particularly at subscale fintechs, where valuations might be more attractive now.
Looking for strategic add-ons, licenses, tech, clients.
Exactly. Bolt-on acquisitions that can accelerate growth or fill capability gaps. It seems like a sensible approach in the current market.
Okay, so pulling this all together for someone looking at DLO, what are the key takeaways?
Well, on the plus side, you have that really strong TPV growth, the fantastic net retention, the benefits of diversification, clear investments in tech for efficiency, and now a dividend policy.
Demonstrates a resilient model in growing markets.
Definitely. But on the other side, you need to watch those dynamics in Brazil and Mexico. Keep an eye on processing costs and margins.
And the competitive landscape isn't getting any easier.
Absolutely not. So it's a picture of significant opportunity driven by emerging market trends, but also specific execution risks and competitive pressures to monitor.
Right. Which brings us naturally to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas.
Always fun. Okay, you first.
All right. Idea 1. Given DLO's emerging market focus and that new dividend, consider going long DLO, but pair it with a short position in a big established payment processor focused mainly on developed markets.
The thesis being emerging market growth outpaces developed, and the dividend gives DLO some cushion.
Exactly. Capture that differential. But again, purely speculative, not advice. Do your own homework.
Totally. Okay, my turn. Idea 2. Thinking about DLO's heavy push into AI and automation for efficiency.
Yeah.
Maybe a long-term play on DLO combined with a small short on a legacy payment company that seems, well, slow to adopt similar tech.
Betting that DLO's tech edge leads to better profits and market share over time.
That's the thought experiment. Again, highly speculative, just an idea, not a recommendation.
Understood. So wrapping up on DLO's Q1 2025. It really shows a company executing strongly in a very dynamic space, emerging market payments.
Yeah, they seem to be balancing investing for that future growth, particularly in tech, with returning capital now via dividends.
Definitely one to watch. Progress in those key regions, Brazil and Mexico especially, and how well they leverage that technology investment will be crucial.
Agreed. As always, we recommend you check out the full earnings call transcript yourself. Do your own research.
Absolutely. What are your thoughts on DLo's path forward in the whole emerging markets payment scene? We'd love to hear them. Join the conversation online.